do want to, as always, talk a little bit about Stocks and Commodities Magazine. I feel like a broken record sometimes, but great sponsors of the event. Really appreciate their support. Great magazine. You should get a copy of it. And you will get a copy of it if you buy any of the add-ons that we talked about in the session today. So, in any case, for recordings, for the recordings, if you want us to send you the recordings, we will automatically. You don't have to ask for them. You don't have to ask for them individually. We'll probably have them on Wednesday or Thursday of next week. It is a lot of audio and video for our web team to process and convert and get up to YouTube. But as soon as they're available, I'll let you know. So, in any case, let's talk about the next presenter, Chuck Hughes. Chuck Hughes is somebody that I've actually seen his brokerage statements on more than one occasion. He's a great trader, and he has very specific methodology for trading the markets. I forgot I was sharing my screen here, but he also has pretty good backstory as well. So I keep doing that. Hold on just a second. He was, I ask a question in a lot of the in-person classes that we do, what's the best occupation for a trader? And the answer to that is actually airline pilot, and Chuck Hughes is an airline pilot. He was an airline pilot for a number of years. He's been trading for a number of years, and like I said, I've seen his brokerage statements are pretty impressive. I think he's probably going to show them to you again today. But he's a great technician. I really like his methodologies. You're in for a real treat with this one. So, Chuck, let's go ahead and get your microphone turned on. Make sure we can hear you. I'm going to turn the presentation controls over to you.
Okay, can you hear me, Jeff?
You sound great.
Okay. All right, good. I'm going to try to set up my slides here. Just let me know when you can see it.
We can see it, and click it in slideshow mode. Yeah, you got it.
There we go.
Perfect. Well, I feel like I stumbled a little bit on your introduction, Chuck. I'll be honest about it. What specifically would you like to tell us about yourself?
Oh, okay. I was an Air Force pilot and then an airline pilot, and on my layovers I studied trading, and when I was home in between my trips I would trade, and I just developed a real passion for it, and I've been trading for 31 years now.
Awesome. Well, we're running about 2 or 3 minutes late, which is no big deal. I'm going to let you get started, though. I'm just going to get out of the way.
Okay, sounds good. Well, thanks everybody. It's great to be here today. This is Chuck Hughes from Hughes Optioneering, and we're going to talk about our options trading program today. The strategies you'll see today have a long history of profitability and actual trading, and as Jeff mentioned, I'll show you some of our brokerage statements, and we're going to talk about our trade selection process today for options. We call it Prime Trade Select, and pretty simple steps. It's a simple trend following system. There is a MetaStock module available for Prime Trade Select, so you can screen stocks and select options on stocks that qualify as a buy for Prime Trade Select. And we have 3 easy steps that go into Prime Trade Select, and we've been using it for many years. And then I'll answer some questions at the end if we have time. I'm also going to show you, I looked at our brokerage statements yesterday, and over the past year we had $1,351,000 in closed trade profits. So I'll run through those real quick, and that just shows you our actual option trades. This slide says 2 years, but this was only over the past year. So we'll take a look at that. And just as a little background, the optioneering team has over 60 years of combined trading experience, and we started teaching our strategies to other traders 21 years ago. I started out with a $4,600 trading account. That was 31 years ago, and my tax returns show that those first 2 years that I traded, I had $460,000 in profits trading options. So started out with a $4,600 account, had $460,000 in profits, which was more than I made the previous 6 years as an airline pilot. So I was on my way there. The optioneering team has received a total of 13 World Trading Championship trophies, including 8 first place, 4 second place, and a third place. I've won the trading contest 8 times, which is more than any other trader. The contest is actually, it's a real contest, and the results are audited before being posted on the sponsor's website. So last year I took first place with a 309% return, and the year before I had a 339% real-time return, showing trading the strategies that I'm going to show you today. So I'm not trying to brag, I just want you to know that these strategies work in real time. So let's look at the first part of Prime Trade Select, and that's selecting an option trade. And we use a simple 50 and 100-day EMA system to determine the price trend of a stock. Then we select a low-risk entry point for our option using the Keltner channels. And once we decide that we're going to buy a call option, then we use what we call the 1% rule to select the option strike price. As you know, that there can be thousands of different strike prices. So we have a simple rule of thumb for selecting the strike price, and we've had a lot of success with it. And then part 2 is the trade management. We use a simple 30% stop loss when we trade options, and we just exit if we're wrong. If we have a 30% loss in our option trade. Then we have what we call the 30% rule for protecting profits. And what we do is anytime we have a profit in an option, we create a spread, and this helps protect the profits, and this has worked out very well over the years because a lot of times we'll have a winning trade and we'll create the spread, and then the stock goes down, and it would have been a losing trade, but it turns out to be a winning trade because we had the spread on. And then we roll over our options at expiration if the stock is still on a Prime Trade Select buy signal and if the trade is profitable. And all our trades are longer term. They're usually we go out 1 to 2 to 3 months, so no need to watch the market closely. We just look at our positions once a day, and if we're getting near a stop loss, we'll just exit, and if we have a profit, then we'll create a spread. So no need to watch the markets closely with our trading. Like I say, it's longer term. Okay, let's look at step 1 of Prime Trade Select, and that's determine the price trend. And the goal of a trend following system, of course, is to quantitatively measure the buying and selling pressure of a stock, and that allows us to follow the trend instead of trying to predict where the trend's going to go. And we've been using this successfully for more than 30 years. In our trend following system, it worked well during the 2002 and 2008 bear markets, and we were heavily short the markets, and we had really good years those years with our short positions. So we also use it to select short trades. Right now the market's in a general price uptrend, so we have long positions now, but we will switch to trading short positions if the major trend in the markets goes down. So we trade from both sides. Right now, the examples I'll show you today are long trades. And we have very simple rules with our trend following system. If the 50-day exponential moving average line is above the 100-day EMA, then that stock is on a buy signal. And if the 50-day EMA is below the 100-day EMA, then that stock is on a sell signal. And we purchase stocks or call options on stocks that are on a buy signal, and we purchase inverse ETFs or put options on stocks that are on a sell signal. So again, the trend following works in both bull and bear markets. So let's look at an option trade we made using Prime Trade Select. This is for Cigna, the health insurance company, and this is a daily price chart of Cigna, and these red and green vertical lines represent the daily price movement of Cigna, and this blue line is the 50-day exponential moving average. The red line is the 100-day exponential moving average. You can see back in September, the blue line crossed above the red line. So whenever the blue line's above the red line, then that stock's on a buy signal. So we can see right here it went on a buy signal, and as long as the blue line is above the red line, then that stock remains on a buy signal. Here's an example of a sell signal. This is for the China equity ETF, and I forget the FXI, I think the symbol is for that. So we can see that the blue line, which is the 50-day EMA, right here crossed below the red line. So right here, the FXI became a short. I think this was, I think this occurred last June or July. The FXI went on a sell signal. So as long as the 50-day EMA is below the 100-day EMA, then that stock or ETF remains on a sell signal. So pretty simple trend following system. And once we determine that a stock is on a buy signal, then we want to select a low risk entry point using the Keltner channels. And we found the Keltner channels to be very helpful in our trading, because we use them to help time our entry and our exits. They also provide what we call high probability buy and sell signals, and they can also be used to help select option strike prices. And we like to just focus on the stocks that have a repetitive and predictive price pattern rather than volatile stocks that have no clear trend. So if you just look at these Keltner channels, you can pick out these stocks. So here's an example of the Keltner channels, and this is the daily price chart for Home Depot stock. The red and black lines are the daily price movement of Home Depot, and then overlaid are the Keltner channels. This is the upper Keltner channel here, this blue line, and the middle Keltner channel is this dotted line in the middle right here, and then we have the lower Keltner channel. And the Keltner channels act as an overbought, oversold indicator. They're very similar to the Bollinger Bands, and what we do is we just monitor the stock price in relation to these Keltner channels, and when a stock is trading up near the upper Keltner channel or even above it, then the stock is getting overbought. And then usually what happens when it's trading near this upper channel, it's getting overbought, it usually retraces back down to the middle channel or the lower channel, and that's when we want to enter after the stock has retraced a little bit. We don't want to buy it when it's trading up near this upper channel or if it's trading above it. So we can see right here for Home Depot stock, it got up near the upper channel, became overbought, then sold off, became oversold when it came down to the lower channel, and then rallied after that oversold condition, became overbought again, sold off, and then became oversold and rallied. So you can see that it follows this pattern. When it gets overbought, it retraces, and then rallies, overbought, retraces, rally, overbought, retraces, rally. So we like to pick our entry point when it's near this middle channel or lower channel, and I'll show you some actual trades that we took using the Keltner channel. So the idea here is you don't want to buy when it's trading near the upper channel. Here's an example of an actual trade we took recently. This was for the XLP, the consumer staples, and this is the daily price movement here, daily price bars of the XLP, the upper Keltner channel, middle, and lower, and we waited until it retraced towards the middle channel here, and then we went ahead and bought the 45 strike call and paid $6.50 for the 45 strike call. And then after our entry, you can see that the XLP continued to rally. Here's another example. This is for Amazon. Again, on a pretty strong uptrend here. And the question is, if you want to participate in this uptrend, where do you take your entry? So that's where the Keltner channels come in handy. So we can see that a strong price uptrend, and we waited until it got right here and went ahead and bought the 330 strike call right here. And then we can see after we got that entry point, then Amazon stock rallied. So that allowed a low risk entry. Here's another example of a trade we took for Starbucks, and again, Starbucks on a very strong price uptrend, the chart going from lower left to upper right, and the question is, where do you jump in if you want to participate? So we waited till Starbucks retraced here, and then we bought the 40 strike call right in here, paid $13.75 for that call option. So again, the stock after our entry rallied, and the Keltner channels allowed us to get low risk entries in these examples because the stocks didn't retrace much from where we entered the trade. So this helps prevent getting stopped out of your position, and will increase the accuracy of your trading if you wait till the stock has retraced from the upper channel towards the middle or lower channel. And then prime trade select step number 3 is to use what we call the 1% rule to select the option strike price. And once you select an option trade, there can be hundreds or even thousands of strike prices to choose from. So selecting the strike price is just as important as the trade selection itself. And option premiums consists of time value and intrinsic value, and at option expiration, options lose all of their time value. So when you buy an option, you're buying a decaying asset. Each day, the time value portion of that option is going to decay, and then once it gets to expiration, then it loses all time value. So you always want to keep that in mind when you're buying an option. You're buying a decaying asset. So due to these time decay characteristics, when we buy an option, we want to minimize the time value because it's going to be 0 at expiration, and we want to maximize the intrinsic value. So we have a simple rule of thumb, and we limit the time value portion of an option to less than 1% of the stock price. We limit the time value to less than 1% of the stock price per month to minimize that time value, which is going to decay to 0, and to maximize the intrinsic value. So if you limit the time value portion of an option to 1% of the stock price, then the stock only has to go up 1% in order for the trade to break even and for you to start making money. So with this rule of thumb, stock only has to go up 1% and you start making money. So this will have a much higher probability of being profitable than an option strike price that requires, let's say, a 6 to 10% increase in the underlying stock to break even, because you may never get that. If you buy a 1 month or 2 month option, the stock may not go up 6 to 10%, and if it doesn't, then you're going to lose all your premium, and we don't want to be in that position. So we buy these in-the-money options that have low time value, and that way the underlying stock only has to go up 1% and we start making money. So let's look at an actual example. This was for Starbucks, and at the time Starbucks was trading at 53.63, and it was on a prime trade select buy signal, so we bought the 40 strike call at 13.75. So this would be with the stock trading at 53.63, buying the 40 strike call. That would be an in-the-money option. And let's look at the time value portion of this option. So again, with the stock trading at 53.63, if you subtract the strike price, we bought the 40 strike call, then we get the intrinsic value of the option. So the intrinsic value of the 40 strike call would be 13.63 in this example. And if you take the total premium, we paid 13.75, and if you subtract the intrinsic value, you can see that the time value portion when we bought this option was only 12 cents. So what that means is Starbucks stock only had to go up 12 cents, and we start making money on this trade. So that represents the 12 cents. That's about 0.2%. So we developed 6 different calculators that will calculate the profit potential for option trades for our various strategies. And what these calculators do is you plug in the stock price and the strike price of the option and the premium, and then it'll calculate the profit potential based on different price changes in the underlying stock at expiration. In this example, from a 30% increase in the stock price to a 5% decrease. So at the time Starbucks stock was trading at 53.63, we bought the 40 strike call at 13.75. So this bottom row here will give you the percent return based on the price movement of the underlying stock, and the second to bottom row right here will give you the dollar profit or loss. So we can see that at option expiration in this trade, if Starbucks is flat and it's at 53.63, then we'll lose 0.9%. So we'd rather lose 0.9% than 100% if you buy an at the money or out of the money call, and the stock is flat at expiration, then you lose you would lose 100% of your premium, or close to 100%. In this case, we're just losing 1%. So you can see, even if the stock goes up 10%, even with this in-the-money call, we're still going to have a 38% return potential. If the stock goes up 20%, we have a 77% return potential. So even though we're buying the in-the-money calls that are more expensive, we still get a decent return if the stock goes up. So with the stock trading around 59, we had like a 38% return for this option. So you can see that this actually deleverages your option trade, and you make less money on the upside, but you also lose a lot less. And you can employ our stop loss rule when you buy these in-the-money options, and if the premium, if you start to get around a 20% loss, we start looking to exit, and we'll just exit by the time we have a 30% loss in the option, and then we go on to the next trade. So this helps prevent 100% loss when you're trading options. So in this example, with only 12 cents of time value, the Starbucks stock only has to increase 12 cents, and we start making money on the trade. Okay, so the Prime Trade Select has developed a lot of profitable trades. So we also have 3 trade management rules, and we have a stop loss rule of 30%. We have a 30% rule for creating an option spread, and then we also roll over at expiration if the stock is still on a Prime Trade Select buy signal. So our stop loss rule is pretty simple. If the options, if the price drops 20% below our entry price, then we start looking to exit, and then if it hits 30%, we're out by then. But we usually get out way before then. If it's around 20%, we'll usually just take our loss and move on to the next trade. So here's our second trade management rule, and that's the 30% rule for protecting profits. And what we do is if we have a 30% profit in an option, we'll create a spread trade, and that provides downside protection and helps protect the profits in case the underlying stock goes down in price. And of course, spreads have a long position and a short position, and the long position profits as the underlying stock moves up in price, and the short position profits as the underlying stock moves down in price. And it's possible for these spreads to profit even if the underlying stock increases in price, remains flat, or even declines in price. And it's also possible when you create these spreads to lock in a profit for your call option purchase, and you'll have a guaranteed return on that call option no matter what happens to the underlying stock. So we like to call these market neutral spreads because they have a long and a short position. And what we do is if we have a profit in a call option, we simply buy a put option, and it's usually an at-the-money put option to protect those profits. And of course the call option profits as the underlying stock increases in price, and the put option profits as the underlying stock decreases in price. And your risk is limited to the cost of the spread, and also there's no limit on the profit potential of the spread if the underlying stock continues to increase in price. So you have limited risk, and at the same time you have unlimited profit potential. So that's what you always want to look for when you're trading options. And we'll look at a few examples. These are put options we created. We had we owned Amazon call options, Google, Facebook, Netflix, Starbucks, and the healthcare ETF. So we had profits in these call options, and we bought at-the-money put options, and in all of these cases, that allowed us to lock in a profit for the call option no matter what happened to the price of the stock. So and just about all of these did have a sell-off after we bought the put option. So in most of these, we were glad that we had that put option for protection because it locked in a guaranteed profit for our call option no matter what happened to the underlying stock. So let's look at some examples. This first one is for Home Depot. Home Depot is on a Prime Trade Select buy signal. We used the 1% rule for selecting an option strike price, and we had a 30% profit in the option, so we bought a put option. And we roll over these put options. We usually go to 3 to 6 months out when we buy the put option. So we bought this brokerage account statement shows that we bought 45 of the Home Depot 80 strike calls at 10.15, and so we had a $120,000 profit in this. And what we did was we had a put option to protect this profit, and as we got close to option expiration, then we rolled over the put option. So we bought the 110 strike put option at 420. which was at the time was close to at the money. So we had a profit in the Home Depot call option. We had a put option that was expiring, so we closed that out, and then we went out another 3 months and bought the 110 strike put option for 420. So again, we were long 45 of the 80 strike calls at 10.15, bought 45 of the 110 strike puts at 420. So once we bought that put, we closed out the option that was expiring, and we went out another 3 months and bought the at-the-money put for 420. So that once we bought that put, we created a market-neutral spread for Home Depot, and we do have a option calculator that will calculate the profit potential. And in this case, at the time, Home Depot stock was trading at 115.17. We bought the 80 strike call at 10.15, and we bought the 110 strike put at 420. And this will calculate the profit potential based on the price of Home Depot stock at option expiration, in this example from a 30% increase to a 100% decrease. Of course, we don't expect Home Depot stock to go down that much, but I just put that in there just so you can get an idea of what happens with these spreads if the stock really declines in price. And we can see that if the stock is flat at option expiration at 115, then we'd realize a $2,082 profit for each one of those contracts that we had, and 145% return. So if the stock is flat, we get 145% return. If the stock is up 10%, then we get a 225% return. And you can see as the stock goes up, your profit potential also goes up. So unlimited profit potential, and your profits just keep increasing if the underlying stock goes down with these market neutral spreads. And then if the stock goes down, you also make money on these spreads because you own the put option. So if the stock goes down 40%, you have a $2,600 profit in the spread and 185% return. And the more it goes down, the higher the profit potential. Of course, we don't expect the stock to decline that much, but you can see that you do get fully protected even if the stock goes to zero. So in this case, our minimum return is 145% return for the spread. And of course, we already had a profit in the call option, so that's part of the return. But by rolling these puts over, every 3 months or so, or every 6 months, we buy that put option to protect it, and you can get up into these kind of returns once you do that. Here's another example. This is for the healthcare ETF, and this brokerage statement shows we owned 64 contracts of the 50 strike call at 9.60. So we had a profit in this call option, and we went ahead and bought a put option. We bought close to at the money, so we bought the 75 strike put option at $4. So owned the 50 strike, had a profit, and to protect that profit, we bought the 75 strike put option at $4. And this shows we owned 64 of the 50 strike calls at 9.60 and bought 64 of the 75 strike puts at $4. And again, this was a rollover, and on this one we went out about 6 months on the put option rollover. When the put options expire that we owned, we just close out the expiring put option and then went ahead and bought another at the money put option. And here's the risk profile for this trade. Again, with XLV trading at 71.44, bought the 50 strike put 9.60, bought the 75 strike put at 4, and then we can see if XLV was flat at option expiration, we'd have a $1,140 return, 83% return, and as the XLV goes up in price at expiration, our profit potential keeps increasing, and if it goes down, our profit potential increases too. So we locked in an 83% return with this trade by buying the put option. So what I'm now, this is just a portfolio of market neutral trades for Cigna, Costco, J&J, Starbucks, Wells Fargo, and Yahoo. And what I did is I took a snapshot of our open trade profits for this portfolio of market neutral spreads. And this column, this was in a smaller IRA account, this column lists the dollar profit for the call or the put, and this column lists the percent return. So let's look at the potential return for this portfolio. And what I did is I took each one of these trades and I put them into the market neutral calculator and then just got a return for the portfolio as a whole. So the combined portfolio, which was Cigna, Costco, J&J, Starbucks, Wells Fargo, and Yahoo, this table shows the percent return for the portfolio of these market neutral trades. And we can see that on average, if that portfolio of trades was flat at option expiration, we'd have a 277% return. If the stocks in the portfolio on average go up 10%, we'd have a 711% return. So you can see, and with this portfolio, we have a minimum return of 277% if the stocks on average were down or were flat at option expiration, and if they go up 10% on average, then we have a 711% return. So and you can see if the stocks on average go down, if we hit all of a sudden a bear market or a severe downturn, and the stocks go down 20% on average, we're going to have a 1,200% return. So this is just this just gives you an idea of a portfolio of market neutral trades, and in this portfolio we have a guaranteed profit of 277% no matter what happens. So it's a pretty comfortable way to trade options, and pretty low risk, a low stress way to trade. So the nice thing about these market neutral trades is once you put the trade on, once you buy that put option, you can just forget about the trade until option expiration. There's nothing to do because you're fully protected if the stock goes down. So it's a very low risk way to trade options, and of course we do have some trades that are initially stopped out, and we'll take our 20% loss or 30% loss and then move on to the next trade. But once we get a profit in a trade, we'll create that market neutral spread, and then every 3 to 6 months we'll roll over that put, and that will lock in a profit for us. So a really great way to trade options, and we don't care about earnings reports, we don't care about bad overseas news because we're fully protected once we buy those puts, and we can just ignore everything in the market and just look at the trade once we get to option expiration, because there's really nothing else to do once you set up this market neutral trade. And here's an example. We had a MasterCard call option, and we had a profit in it. We bought the at-the-money put, and then MasterCard, right after we bought that put, had a bad earnings report, so it sold off pretty hard. So by buying the put, we locked in a $41,000 profit and a 1,353% return because the stock went down and the put option went up in value, so we had a big return for this one. And if we had not bought that put option and we only owned the call, in this particular case, the call would have expired worthless because the stock dropped so much. So here's a case where we locked in a profit, and if we had not had the market neutral spread, we would have had a total loss for the call option. So these kind of unexpected moves in your stocks or ETFs, they can occur, and when you least expect it, all of a sudden there's bad news for your stock, and it drops 10 or 20%. But we don't worry about that because we're fully protected, and we have a very low risk way of trading. So there's no need to monitor the markets. Once you put on this market neutral spread, you can just take the trade and forget about it. And that portfolio I showed you in a smaller account, that only cost $1,715 if you trade one option contract. So that portfolio that I showed you, the returns for the portfolio as a whole, just trading one contract, that was only $1,715 after commissions for that contract, or for that portfolio. So here's just some examples, open trade profits in some of our market neutral spread portfolios. This one is a profit sharing plan that we have, and that at the time had a $70,000 profit. Here's another retirement account we have. This is a bigger account, and when we took this snapshot, we had $199,000 open trade profit, and the positions are listed in this column. This is the dollar profit and the return for the call or put. So you can see in this case the put options, we had losses on the put options, but we had much bigger profits on the call option. So like for Facebook here, we had a $3,900 loss on the put, but we had a $53,000 profit on the call. So we'll gladly make that trade-off. Here's Apple. We had a $74,000 profit on the call, $7,000 loss on the put. So sometimes the puts are going to lose money, and we're glad to do that because they provided protection. Sometimes they will increase in value if the underlying stock goes down. So I'm just going to run through our closed trade profits over the past year. This was from April 21st of 2015, April 21st, 2016, and this is just a list of our trades, and we had $806,000 in long-term capital gains, and we had $544,000 in short-term gains. So this is just a snapshot of our closed trades over the past year. So we had $1,351,000 in closed trade profits. I'll just roll through these really quickly. Most of these were spread trades, so we may have had a loss on one side of the trade, but if you net out the long and the short position, we had profits in most of these trades. So the short side may have lost money, but we had profits on the long side. So those were our trades over the past year. And this is a snapshot of open trades. Took a few months ago, and at the time we had $853,000 in open trade profits, and these are just snapshots of our positions and profits for our two portfolios of spread trades. So we do have an advisory service where we do make recommendations for these market neutral spread trades and also option trades, and I took a snapshot for the market neutral portfolio, and we had this shows the positions we have over here, the dollar profit or loss and percent return. So for the market neutral, we have a $200,000 open trade profit and 90% average return. And the nice thing about this portfolio is no matter what happens to these underlying stocks, this will be guaranteed a profit with this portfolio because of the market neutral spreads that we have in this portfolio. So very comfortable way to trade. So if you want to get updates on our various strategies and the percent return that we have, if you just log on to weeklyoptionalert.com and click trade results, it'll give you the current trade results for the various option strategies that we use. And you can see we have a option portfolio, small account option, covered calls, option spreads, and market neutral portfolio. So we trade all these strategies with the advisory service. So that concludes my presentation. I'd be glad to take any questions. Okay, let's see here. I can pull out my questions here. Okay, there's one question here. Chuck, do you sell calls for income? And the answer to that is yes. I didn't do that in today's presentation because we're limited on our time, but there's two ways we sell calls. We have a covered call strategy that we use, and we also have an option debit strategy. So with both of those strategies, the option debit spreads and the covered calls, we do sell calls for income. Here's a question: can I do this in my IRA account? Most brokerage accounts, most brokerage houses will allow you to do these market neutral trades in your IRA account. We do them in our IRA account. We have 3 different types of retirement accounts, and our brokerage house allows us to do these in all 3 of them because you're buying, you're buying a call and buying a put, so it's not really very high risk. And I think you only need option level 2 for this for most brokerage houses. Okay, here's a question: do the puts and calls have the same expiration? And usually they do not have the same expiration. So what we'll do is if we have a profit in a call option, and we'll go out maybe 6 months on the call option, and then we'll go out 3 months on the put option. So that put option will expire before the call option expires. So we simply roll it over when the put option expires, and then we go another 3 months out or 6 months out. So normally the expirations are not the same. Okay, here's a question. You have a profit in the call, a 30% profit in the call. It says, do you buy or sell the put? And we buy the put. We buy the put for protection. And if you buy the put instead of selling the put, then there's no cap on your profit potential. And you saw in those examples of our market neutral trades, because we bought the puts to protect the trades, if the underlying stock continues to go up in price, then the profit potential just keeps increasing. So that's a result of buying the put, not selling the put. Whenever you sell an option, then your profit potential is limited. Okay, so here's a question. To achieve the 1% rule, you must be deep in the money. Yes, that's correct. When you use the 1% rule, the idea is that you want to have a higher percentage of winning trades rather than a larger win on a trade as opposed to trading, let's say, an at the money or out of the money call. So it's a trade-off. So we buy, with 1% rule, we buy in the money calls, and it's a trade-off. Our upside potential is not as great with an in the money call, but the downside is much better. And you saw in the example of that Starbucks option that we bought, if the stock is flat at option expiration, we lose 1% on the option, but if you had an at-the-money or out-of-the-money call in that situation, then you would lose either 100% or close to 100% on the option, depending on where the strike was. But so we like to avoid those 100% losses. We don't like to incur those because it doesn't take very many of those and you're wiped out. So we'll gladly take that trade-off. We have less upside profit potential when we buy the call, but we have a much higher percentage of winning trades, and we have a much higher probability that the call will have a 30% profit so that we can create that market neutral spread. So it works out really well for us. Okay, how do you determine the put strike to buy? We simply buy an at-the-money put, sometimes a little out of the money, but close to at the money with the put option. Okay, does the decay or buying the stock apply here? I'm not sure what that question's asking. Okay. Okay, don't lose the volatility and time premium if you have at-the-money options unless you can time the stock move accurately. Well, when we buy these puts, we're not trying to time anything. We simply, we have no idea what the future brings. We know we have a profit in the call, so we simply have a money management rule to buy that put, that at-the-money put. And we don't know what's going to happen. We're not trying to time anything. We do know that if the stock declines, that in most cases the put will guarantee a profit no matter how far the stock declines. And if the stock goes up, then the profit potential is not limited. So we don't try to time the market. We know that if the stock keeps increasing in price, our profits will keep increasing, but we know if the stock goes down, once we have that market neutral spread on, that, you know, in most cases we're guaranteed a profit. So I wouldn't really call that trying to time the market. We're just trying to get a low-risk entry using the Keltner channels, and then if we're wrong, we simply get out, normally at around a 20% loss, and if we're right, then we create that spread to help protect the profit. So all in all, we found that that's the best way to trade the option markets. Okay.
And I think it's time to start playing the music on you.
Yeah, that's fine.
All right. One of the things that I forgot to mention, and I hope you did during your presentation, but how many times have you won that World Trading Competition now? You won last year, right?
Yeah. So I won last year, and I have eight wins in that. So that's more than any other trader.
Yeah, it's a record for the competition. All right, very good.
Yes. Yeah.
If you guys have questions, I know there's always questions we don't have time to answer. Chuck did a really good job, but just give Brad a phone call at 866-661-5664. And thanks, Chuck. I really appreciate you coming in today. Great presentation as always, and we'll see you at the next one.
All right, that sounds good, Jeff. Thanks, everybody. It was great being here today. Have a great day.
All right, very cool. Now, so yeah, as Chuck had mentioned a little bit earlier, we do have the Prime Trade Select method. It's the last add-on that we're really going to talk about today that's available in the catalog, and it does a really good job. I said earlier that I very much enjoy my job of working with these championship traders and really people that are the best in the industry and making their methods available to you in a way that you can scan for and identify and find trades. And We don't have really a lot of time to talk about the add-on, but it looks a lot like the other add-ons. It basically takes his method of determining the price trend, confirming the price trend, and determining a low-risk entry point, and just really kind of allows you to scan through and find the trades that work and are set up and are going for right now. So it's an awesome product. Just to show you a couple of screenshots of the product itself, we're going to kind of skip through this so that we don't step on Kurt's toes coming up. It does have the buy alerts. It does tell you when to sell. It's a long system, so it doesn't short the market. It only goes long. And it'll tell you when to get out of a third of your position and when to get out of it the next third and when to get out of it. So there was a lot of questions about how do I get out, or where are my stops, or how do I get out. And those are very, very specific and very, very easy. Actually, if you notice down here in the bottom of this commentary, there's actually suggested exit guidelines. So it'll tell you exactly, well, number one, you want to have a trailing stop loss at 10 to 15% below the entry price. 2 and 3, I don't think I have on this slide, but it tells you exactly where those stops need to go. Very quickly, you can go in, and it is built for stock and option trading, so you can scan through the optionable stocks in the US and just find the ones that have a matching buy signal or a matching sell signal for that day. Really great product. Very, very, like all the products we're talking about today, it's been one of the best-selling products that we've had in our catalog. A lot of people that have taken Chuck Hughes products have also kind of picked up the add-on, and a lot of our customers have picked it up as well. So normally it's dirt cheap. It's $299. Now it's a one-time cost. You pay for it and you own it. It comes with a 30-day money-back guarantee. Today you can get it by itself at $100 off. It's normally $399. It's $299 here at the event. And then again, if you want to get some of the other add-ons, which I'd encourage you to do so, you're going to save up to $100 on each one of them. $50 if you buy one, $75 if you buy two. If you buy 3 or more, you'll save $100 on each of them. Again, that includes 2 years of Stocks and Commodities magazine. So now we've had a chance to look at all of them. I hope you really like the add-ons and what you've seen so far. If you have any questions or if you want to place an order, give us a call. The phone number is 800-882-3040. You can also do it online. We do have some reps that are standing by. They're really good about helping you understand how to get everything started. So give us a call, 800-882-3040. And again, you can also do any of the extended trials that are available with MetaStock, either the daily chart version for $59 a month or the real-time version for $250. You pay for 1 month, you get 3 months for free. Very inexpensive way to try out MetaStock and see for yourself why it's been rated #1 for 26 years in a row. So all the add-ons will work, Paulo, on Windows 10. We all use Windows 10 here in the office. I actually love Windows 10. I think it's probably one of the best versions of Windows ever. So, but yes, it will work on Windows 10. The price of the add-on, its retail price is $399. So it's $349 if you buy one, $75 minus $399 if you buy two. If you buy 3 or more, you save $100 on each of them. So it's $299 if you buy 2 or more. Thanks for the clarification, Steph. And I did have, to be honest, I had a little bit of a typo in the PowerPoint, which, you know, there's like 123 slides in here, so I guess one typo I'll give myself a pass for. There's 2 more guest speakers, Trey. Trey, you're not one of them. I almost said Trey is next. Kurt Christensen's next, and then we're capping it off with Howard Johnson. Wim says it's really hard to decide on which one to buy first. They all look really good. They are all really good. And we do offer a 30-day money-back guarantee. I'd recommend you pick 2 or 3 of them and get the good discounts and see which ones really, really work for you. But I really appreciate that comment. We put a lot of time into making the add-ons good. I'm in charge of making sure they're good, so I'm glad they look good. MetaStock CISA does not work on a Mac, but it does work on a Mac if you install Boot Camp and like Windows. I'd recommend Windows 10. My email address, Wendy, you're more than welcome to reach out to me, jeffrey.gibby@metastock.com. I'm typing that out because not a lot of people know how to spell Gibby directly. So, whew. No problem. No problem. Okay. Again, it's been rated #1 25 years in a row. Can't go wrong. Do want to spend just a minute saying thank you to our sponsor, Stocks and Commodities Magazine. Great magazine, great partner, a great strategic partner. Just love the guys over there, and they do such a good job of working with us and helping us make this event the success that it is. Again, hopefully you opted in to get a free copy of the magazine when you signed up for the summit today. And if you buy any of the add-ons, you're going to get a complimentary 2-year subscription to MetaStock, or I'm sorry, to Stocks and Commodities. And if you just subscribe to MetaStock, you'll get 5 months for free. So it's great.